On board Srinivas Ravuri, who is CIO at Bajaj Life Insurance, joining us this afternoon. I beg your pardon. Srinivas, great having you. Let me first start off with the market itself, Srinivas. We've seen a bit of a derating, since the highs of the year. But how is it that you're looking at the texture of the market currently in around the 24K mark?
Yeah, hi Harsh. Thanks for having me on your show.
Great having you.
Yes, Harsh. So I think the way we are looking at market is we've been waiting for numbers to come out and numbers to be relatively weak. On the contrary, the first quarter numbers till now, whatever we saw, have been actually better than expectations. I think to that extent, there is a positive surprise from companies, corporate India. And we also saw the war taking a stop and crude coming down, which is a big positive for Indian economy and markets. However, I think again we saw last 10 days things again going back and crude touching 100 has been a big challenge. But I think finally and eventually what we all focus as analysts is on corporate earnings and earnings direction. On that front, I think if you see FY25 and FY26, both years we saw a lower single digits earning growth in Nifty 50, close to 5%. Versus that, now we are heading into year with even today, if I see the consensus numbers, we are talking about almost 15% earnings growth for Nifty 50. So I think, and the first quarter numbers that we saw also reflecting that we will be having a double digit earnings growth. To that extent, things are looking positive. I would say more than the macro issues, other thing that is actually dampening the market sentiment is the supply that is coming in. We are seeing IPO market, which was fairly lackluster in the first quarter ending June. As markets have revived, we're seeing companies and private equity funds who have made very handsome returns in their investee companies as they went public. They want to sell and book profits. I think that trend is accelerating, and that is definitely putting a pressure on overall markets. So I think if I'm looking at the pipeline that we get from the bankers, we are likely to see even more healthy healthy supply in the coming weeks. So finally, at the end of the day, market is about number of buyers versus sellers. When I see more number of sellers, that is definitely having a near-term impact on stock prices. So I would say it's a fairly balanced at this point of time. Valuations are not expensive. That's a comfort, but at the same time, we would like to see maybe lower supply than what we are seeing right now for prices to move up.
And and Srinivas, the other piece I'd love to understand better is your view on IT. You're saying it's a tactical kind of a trade. We've seen some of that unwind already. How much more if it's tactical, and what's the thesis, if you can give us that?
Yeah, so Harsh, thesis is easier to say.
Okay.
Markets move in this pendulum, greed and fear. In the last few months, we saw as the globally investors were excited about what's happening in the AI market. We saw Korea delivering fantastic returns, and also investors trying to invest in companies that will be a beneficiary of this AI or who are contributing to this AI. However, in the last few weeks, I'm seeing, I think month to date, I was told South Korea is down 25%. So there is a concern that whether part of this AI is actually a bubble and people are trying to unwind. Coming to Indian IT sector, so IT sector, we've seen a sharp sell-off for the last few months because Indian IT companies are essentially service provider. Within that, most companies are essentially doing code writing. With the prevalence of AI, I think there is a clear threat to that low and simple code writing for sure. And that is why market was worried, and we saw IT companies being where they are today. However, when I see numbers, as a investors, our job is not to buy best companies. Our job is to buy good companies at good prices. From that perspective, when I see especially the large IT names, when they're trading at good 4 to 5% dividend yield and a price to earning trading at 15 times when market is at 20 times. And also for the fact that rupee has depreciated, which in turn means these companies are likely to report double digit earnings growth in the current year. So I think there is a definitely a risk return trade off that is there, and that's what we are seeing in stock prices as well in the last few days. How long this can continue? As I said, it's a tactical call. We have to be mindful of multiple things. I still think there is more steam left, but the fact is AI is here to stay. The fact is it will lead to lesser demand, pressure on pricing for IT companies, which in turn means some of the IT companies will see severe pressure on their top line and margins. We are here to identify likely beneficiaries of this trend. I'm sure a few of Indian IT companies will actually benefit from this eventually as this plays out on the coming 1, 2, 3 years. But overall, sector headwinds are there and will remain. So I think that's where I'm saying tactical. Still, there is some more upside, but I don't want to quantify that number. It is not possible. It's not easy to quantify that number.
I'll come to pharma in just a minute, Srinivas. The other piece that you're really positive about is power companies. Here, you believe that the earnings growth will be strong next 2 to 3 years. Now, here, do you prefer the larger producers or do you prefer the ones which are shifting towards renewable? Do you prefer the EPC kind of plays? How should one play power?
If I'm seeing, my first preference is for utilities, large utilities. But if I want to see where is the earnings growth likely to be, I would say the highest earnings growth would be in the power equipment space. Companies that are making equipment that go into manufacturing of making of power plants and the T&D value chain is likely to see a very high earnings growth. However, I think the T&D equipment space or the power equipment space, if I'm seeing the valuations, I think there is very little margin of safety there. As I was saying earlier, we would like to buy companies where that margin of safety or where the growth is not fully priced in. Whereas when I'm seeing the power equipment companies, I don't have that comfort at this point of time when I'm looking at expensive valuations.
Okay. And with regard to pharma, where are you placing your bets there?
So pharma, you have multiple drivers. One is pure domestic, other one is CDMO, other one is player and generic. We are more positive overall pharma space we like, and within that we are liking more on the contract manufacturing space at this point of time, given the opportunity that space provides. Yes, there are near-term headwinds, but I think directionally, Indian pharma companies have done a lot and are extremely competitive. As a result, we expect them to continue to do better in terms of earnings growth, Harsh.
And what is it that you would be cautious about in a market like this, Srinivas? What is it that you would probably not want to touch at this point of time? Wait for the pendulum to swing the other way?
See, more than sectors, I think in every sector there are some stocks which are fairly expensive, and there are some sectors that are attractive. I think in a normal market, we generally tend to say, we like banking, auto, kind of a names, and then we say a few sectors we don't like. But I think what we are witnessing in this last 18 months, where markets are more on a consolidation phase, market is rewarding companies that are delivering higher growth and punishing significantly, severely companies are not delivering on numbers across companies. As you can see today, consumption, we saw numbers and then we see a sharp sell-off. So to that extent, as investors, and I think what we have in our hand is making sure that we don't overpay for potential prospective growth. So I would say more than sectors, we should be mindful of the fact that let's not overpay And how do I define overpay? I think let's use a simple metric like price to earning. If you're paying more than 50 times 1 year forward earnings, I will put them in a expensive category. And that's where one should be mindful and careful about investing.
Right, Srinivas, thank you so much for joining us, giving us that perspective. We'll let you
Thank
go.
you.
Thank
Yeah.
you.